This charming clay traveler just arrived in their new city, and those glowing suitcases represent the foreign assets they are bringing with them to Turkey. They're looking to utilize a new piece of legislation known as Mükerrer Madde 20D, which was written specifically for new residents. Under this law, new residents do not pay Turkish income tax on wealth generated outside of the country. To access this benefit, you must apply for and secure an official document called the exemption certificate. Securing this single piece of paper effectively prevents your global wealth from being subject to local taxation for 20 years. Before you can look forward to 2 decades of tax exemption, we have to look back at your immediate past. This factor timeline maps out the primary rule. If you arrive in 2026, we jump back 3 calendar years. You must not have been a resident of Turkey during that specific window. As those red marks show, having any past tax liability for wage or commercial work within Turkey during those 3 years makes you ineligible. However, notice the green check marks. Earning passive income, such as rental yields or capital gains inside Turkey, does not impact your eligibility. This means if you owned a vacation home here or held Turkish stock investments before your move, you can still apply for the exemption. The government structured the law this way to encourage new individuals to move their primary lives here, without penalizing those who already held passive investments in the local economy. Once you have confirmed your eligibility, the focus shifts to the clock. Timing is where most applications fail. Look at the calendar flipping forward. The standard rule is that your application must be submitted by the end of the calendar year in which you become a resident. There is a specific adjustment for people who relocate late in the year, specifically in November or December. For those late arrivals, the magnifying glass shows an extension. You have until the end of February of the following year to file your paperwork. If you miss your specific deadline, the opportunity for the exemption is gone. Administrative delays result in the loss of 20 years of tax-free status, so applying immediately upon arrival is the priority. To begin the process, you must visit your local tax office, or vergidairesi. Your first step is to submit a formal petition so the authorities can verify your 3-year non-residency history. Once they verify your history, they issue this document. This is the EK-1, featuring the official Ministry of Treasury and Finance hire. This specific physical certificate is the only recognized proof of your 20-year exemption status. Possessing this stamped EK-1 officially designates you as an exempt taxpayer for your foreign-sourced income. Holding that certificate requires you to follow strict rules during the annual tax season. The primary mechanism is simple. You must entirely exclude your foreign income from your annual Turkish income tax return. Because Turkey is not taxing that wealth, any taxes you have already paid to foreign governments cannot be used as a credit or a deduction here. This flowchart illustrates the separation you must maintain. You must keep your foreign wealth entirely distinct from your local earnings. While your overseas dividends flow into the tax-free column, any active business or consulting work you do locally within Turkey is directed to the standard tax column. The EK-1 acts as a shield for your foreign wealth, but it does not provide immunity for any local economic activity. Acquiring the document locks in your tax-exempt status on foreign earnings for the next 20 years. However, you must be aware of the risks associated with providing incorrect information. If the government later determines you are actually ineligible, they will revoke the exemption. They will demand all back taxes plus a tax loss penalty, known as vergi ziyağı cezası, and interest. To start the process, download the petition template and locate your assigned local vergidairesi. Following these steps correctly from day 1 secures a 20-year window where your foreign earnings remain outside the local tax system.